If you are retired or about to retire in the United States, there is a tax hike coming that most people will never see in a headline. Your monthly check may look the same. Your lifestyle may not change. But between Medicare premiums, Social Security taxation, and forced withdrawals from your IRA, more of your money can quietly be redirected to the government in 2026 and beyond. And the most dangerous part? You don't need to be rich for this to happen. Many middle-class retirees are already being pushed into higher costs and higher tax brackets, simply because they saved and did the responsible thing. In this video, I'm going to walk you through a silent tax crisis that is hitting American retirees from 3 directions. 1. Medicare premium brackets that punish you for small increases in income. 2. Social Security benefits that become taxable much faster than most people realize, and 3. Required minimum distributions that can shove you into higher brackets exactly when you want stability. This is not personal financial advice. This is a protection briefing, so you can go back to your tax professional or financial advisor and ask much sharper questions. Let's start with why 2026 and the years around it are especially dangerous for retirees. Over the last few years, American retirees have been squeezed from 3 sides. First, inflation. Even if official inflation has come down from the peak, the damage is already done. Groceries, insurance, utilities, and medical costs have all stair-stepped higher. For someone on a fixed income, those steps almost never go back down. Second, market volatility. We've had sharp moves in stocks and bonds. If you retired recently, you might have seen your portfolio drop, then partially recover, then stall. That sequence of returns is extremely important. If you're withdrawing during a down or choppy market, it can permanently damage how long your money lasts. Third, federal deficits and pressure on entitlement programs. Washington is running large deficits. That creates long-term pressure on programs like Medicare and Social Security. When budgets are tight, governments do not always cut benefits directly. Often, they change tax rules, premium brackets, or cost-of-living formulas in ways that are harder to understand and easier to hide. Put those 3 forces together, and you get a dangerous environment. Your costs are higher. Your investment returns are uncertain. And the rules around your retirement benefits and taxes are quietly shifting. Now let's go into trap number 1, how your Medicare premiums can act like a hidden tax increase. Most Americans know that when they hit 65, they qualify for Medicare. What many do not realize is that Medicare Part B and Part D premiums are not flat. They are tied to your income through a system of brackets. The higher your income, the more you can be required to pay in premiums. This is often called an income-related monthly adjustment amount, in simple terms, a surcharge on higher income retirees. Here is where the trap appears. Imagine you are a retiree who has worked hard, saved in a 401k or IRA, and you decide to take a slightly larger withdrawal one year. Maybe you need to help a child, fix a roof, buy a car, or just feel more comfortable with your cash balance. That extra income can push you across a Medicare income threshold. If that happens, your monthly premium can jump, not just for 1 month, but for the entire year. For married couples, the impact can be doubled. So what looked like just a bit more income can turn into hundreds or even thousands of dollars of extra annual premiums, depending on how far you cross a bracket. Visually, think of it as a staircase, not a ramp. You walk 1 step higher, and the floor under you suddenly costs more. This is why planning withdrawals, Roth conversions, and one-time income events around those income brackets matters. A poorly timed withdrawal, a big capital gain, or a late-in-career bonus can show up in your Medicare premiums down the road. Again, your advisor should run the exact numbers for your situation, based on the current law and current brackets. The key idea for you is simple. Medicare is not just a healthcare program. For many retirees, it has become a stealth tax system built into your premiums. Now let's move to trap number 2, Social Security taxation. Many Americans still believe that Social Security benefits are automatically tax-free. That is not true for a large share of retirees. The IRS uses something called provisional income to determine whether, and how much, of your Social Security is taxable. Provisional income is basically your Social Security benefits plus most of your other income, such as wages, pensions, interest, dividends, and withdrawals from tax-deferred accounts, plus some tax-exempt interest. Once that provisional income crosses certain thresholds, up to 50% of your Social Security benefits can become taxable. Cross a higher threshold, and up to 85% of your benefits can be counted as taxable income. Here's the emotional shock many retirees experience. They spent decades paying payroll taxes with the expectation that Social Security would be their reliable, secure income in retirement. Then, when they finally claim, they discover that a large portion is being pulled back into the tax system because they also have modest IRA withdrawals or part-time income. The combination effect is what matters. Your IRA withdrawal adds to provisional income. That triggers taxation on a portion of Social Security. Your total taxable income rises faster than you expected. It can feel like a double hit. You are taxed on the money you withdraw and indirectly taxed on the benefits you thought were largely protected. This is why coordinating Social Security claiming with your other income sources is not just a nice to have. It is central to how much you actually keep. Now, let's talk about the third and final trap: required minimum distributions. Required minimum distributions, or RMDs, are the government's way of eventually taxing the money you postpone tax on in your traditional 401(k), S and IRAs. At a certain age, depending on the current law, you are legally required to start taking money out of these accounts each year, whether you need the cash or not. The amount you must withdraw is based on a formula that uses your account balance and a life expectancy factor. Here is the key danger. In your early retirement years, you might be living happily on a mix of savings, smaller withdrawals, or other income sources. Your taxable income feels manageable. Your Medicare premiums and Social Security taxation might be under control. Then RMD age arrives. Suddenly, the IRS formula starts dictating a minimum withdrawal that could be significantly larger than what you would have chosen on your own. That forced withdrawal does three things at once. 1. It adds to your taxable income for the year. 2. It can push more of your Social Security into the taxable zone, and 3. It can push you into a higher Medicare premium bracket. In other words, the three traps we discussed are not separate. They are layered. Your RMD raises your income. That elevated income triggers higher Medicare costs. And at the same time, more of your Social Security may be taxed. This is why many planners talk about filling lower tax brackets in your 60s, before RMDs and before claiming Social Security, using strategies like carefully planned Roth conversions or more controlled withdrawals. The idea is to avoid one big forced spike later. I want to repeat, your personal situation is unique. Laws change, thresholds move, and only a qualified professional who understands your full picture can give you personalized advice. But here's the core message of this briefing. The danger for American retirees today is not only the big, obvious recession or market crash. It is the slow, silent tightening of rules around Medicare premium brackets, Social Security taxation formulas, and required minimum distributions. If you are in your late 50s, 60s, or early 70s, this is the time to sit down with your advisor or tax professional and ask three specific questions. 1. How close am I to the next Medicare premium bracket? 2. How much of my Social Security is projected to be taxable under my current plan? 3. What will my RMDs look like over the next 5 to 10 years, and how can we smooth that income? On this channel, I will continue to bring you clear, no-nonsense briefings on the U.S. economy, retirement, and portfolio protection, especially for Americans 55 and older. If you found this helpful, consider subscribing so you don't miss the next briefing, where we connect these tax traps to what Wall Street is expecting from the market in the years ahead, and what that means for your savings. Thank you for watching, and I'll see you in the next update.